Job cut announcements soared 193% in August after a few months of steady declines. This is according to the latest report from Challenger Gray Christmas. With more on which industries were most affected and what it could mean for your future, we're joined by Andy Challenger, Senior Vice President of Challenger Gray and Christmas. Andy, great to see you here. Good to catch up. First and foremost here, what is really leading to this surge that we saw in August?
Yeah, after a few months of falling job cuts through the summer, from early spring, we've seen this big spike in August. They were primarily coming from the technology sector, which has been the story for almost 2 years. It's an area that post-COVID has continued to cut jobs at a higher rate than the rest of the industries out there. But we did also see a return of job cuts from education, from government jobs, hospitals, and leisure and entertainment. Some of those lower skill, lower paid jobs that have been really resilient for a period of time. So it's a touch concerning that we're seeing an increase in layoffs coming from those sectors.
You know, one of the sectors specifically that you mentioned within this report, manufacturing job cuts, that jumped more than 200% from last year. And you know, as we think about what was showing up in some of the ISM manufacturing data, there's continued contraction that we're seeing within manufacturing right now. How much of this is a surprise? When do you expect a rebound, and what's it really going to take? Or is this a larger trend that has some inputs, whether that be technology-based, that are going to have much longer-term ramifications?
Yeah, that's a question that's still really up in the air, is what's going to happen to the labor market broadly as we expect the Fed to start to lower interest rates to combat the rising unemployment that we've started to see, the increase in layoffs that we're tracking. Manufacturing in particular is an area that had been resilient for a really strong period of time the last few years. But the fact that we're seeing some losses there is a sign that we might be really approaching that tipping point where the Fed, trying to balance their fight of inflation against rising unemployment, is really going to be looking at closely for their next decision.
You know, also caught our attention here, the total AI job cuts year to date right now. I think it's sitting at a level a little higher than 7,000 as of right now. That's on the rise, and our viewers are seeing this on the screen as well, compared to 2023. Now, some of these were new positions. Some of these, though, were existing positions that were out there, and companies did a lot of hiring to try and either hoard AI talent or bring on new AI talent. So what are you kind of sensing and making of the data and the elevated job cuts in AI at this juncture?
Yeah, AI has been the key topic that everybody's been talking about for 2 years when it comes to jobs. How strongly is it going to affect the labor market with this advent of a new technology? Right now, we are seeing some increases, either from companies saying that they're replacing jobs, a small number, for AI, but we are seeing companies shifting their focus, closing down product lines, reducing the headcount they have in certain departments to grow their human capital within the AI space. So it's certainly something that we're seeing. How far that's going to go, we really can't say. There's the possibility that it starts to erode the market further, the labor market. But one thing that we do know is that companies are less and less likely to talk about artificial intelligence if they are making cuts because of it. They get in the headlines. When they make an announcement around it, they get wall-to-wall coverage. And so there is a real shyness around attributing job cuts to artificial intelligence.
Just lastly, while we've got you here, Andy, you think about for the job cuts, how that passes through to wages as well. Is there any direct corollary that you've been able to check over at Challenger Gray Christmas as it relates to the wages that we're seeing? The best reading that we got this morning was really the ADP payrolls, private payrolls, where it seemed like it was steady, stable, as they put it, for job stayers and job hoppers or job changers.
Yeah, well, we saw for a period of time wages increasing really quickly when the country was in a labor shortage and workers had an enormous amount of leverage in their negotiations and discussions with companies. We've seen that erode as the labor market has cooled to a relatively tepid point where we're at right now. The hope is that we stay here for a little while, and that would mean we're not going to see big increases in wages because of how that also contributed to inflation. That could be a good thing. The real worry is that now that the Fed is looking at lowering the inflation rate, is it going to be too little, too late? Will we dip into a downturn that would negatively affect wages and send them lower, or really stop them from growing over a period of time?
Andy Challenger, who is Senior Vice President of Challenger, Gray and Christmas. Great to have you here with us on the program to break down some of your findings. Appreciate it, Andy.
Thanks for having me.